lower rates is generally pretty bullish for equities short term. From a technical standpoint, have been telling us, hey, get back into the stock market because it's more volatile than bonds generally, and there's more potential upside in the near term for equities. So we've rotated from TLT, we're back into the equities market, and I'm anticipating this market to keep running higher. And we generally see the stock market move higher after the first rate cut, and it can do that for a little bit. Now, the flip side here is
Chris Vermeulen is back. He is a chief market strategist at thetechnicaltraders.com. 2 weeks ago, Chris was on the show. We had talked about giving an FOMC preview, and we reviewed the CPI report that came out at the time. We're going to be revisiting that call and talk about what's next for the markets. Chris, welcome back to the show.
Hey, thanks for having me, David. Always a pleasure.
So always a pleasure to host you. So like I said in the beginning, 2 weeks ago, you were on. The CPI report at the time came out a little bit higher than expected, and the expectation was for the Fed at the time, 2 weeks ago on September 11th, for the Fed to cut by 25 basis points. That's what we talked about. Why do you think the markets have flipped, first of all, and then we'll talk about why the markets behaved the way they did following the Fed's 50 basis point cut last week? Why do you think expectations very quickly shifted to a 50 basis point cut towards last week, which is ultimately what they did?
Yeah, those are all really good questions. I was really expecting myself. I mean, I don't really follow the fundamentals and the rates that closely, but I was thinking it was going to be a quarter basis points. I figure if they go any bigger than that, they might shock the market a little bit. And they ended up doing that. They did a 50 basis point cut, which sparks the question, what do they see that's really bad that we don't know? Because I really don't feel like the economy, I don't really think we need that big cut just yet. Maybe it's because a lot of other countries they're already in a recession. They've already started cutting, like Canada, and they want to maybe catch up a little bit. I'm not sure, but that's kind of a red flag that they've cut that much, in my opinion. Now, in terms of, for example, like bond pricing, as soon as they cut rates, generally, that's bullish for bonds, bullish for the stock market. We have seen the stock market rip to the upside. Simply, if you're going to get lower rates elsewhere, it's going to want to funnel you into the stock market to make more money. But we have seen bonds, long-term treasury bonds, they've pulled back in price. I think it's been a big chunk of that has been kind of buy the rumor, sell the news. It's the same with any large company that they get good earnings, could be, OpenAI or something, but or Nvidia, but the earnings aren't as good as people want, and they sell into it, even though it's really strong data. And so I think that's a little bit of probably what's gone on. I think people have been expecting rates to stop going up, to start coming down for really like a year. You look at the long-term chart of bonds, there's been already a lot priced into the bond market. So I think this is just buy the rumors, sell the news. If we finally have the rate cut, bonds are pulling back. People, I think, anticipated that like a year ago. And so people are just kind of moving out of bonds, just driving the price down a little bit. But I do think bonds are still in an uptrend. I think they're going to rally still over the next several weeks.
Because rates are going to continue going lower? Is that the thesis here?
That's my belief, yeah.
Let's come back to fixed income in just a bit, but maybe flip over to your screen now. I like to talk about what happened to the stock markets immediately following the 50 basis point cut. The S&P is up about 2% according to what I'm looking at on my charts, and the sentiment so far has been quite euphoric. I wonder if the 50 basis point cut that happened last week, has that changed your positioning in the stock markets?
Yeah, so initially we were looking to be long bonds. We were in the bond market in TLT, and then we've got the rate cut, and now lower rates is generally pretty bullish for equities short term, and we've seen equities really pop and rally. And so our strategy that we follow, the money flows and all those things from a technical standpoint have been telling us, hey, get back into the stock market because it's more volatile than bonds generally, and there's more potential upside in the near term for equities. So we've rotated from TLT, we're back into the equities market, and I'm anticipating this market to keep running higher. And we generally see the stock market move higher after the first rate cut, and it can do that for a little bit. Now, the flip side here is, to me, rate cuts are very bearish. Short term, people buy into the equities market, which is what we've seen, but it means the Fed sees something we don't. Things are getting weaker. And typically, the rest of the rate cuts are usually the Fed cutting rates to try to soften the landing, to try to preserve the equities markets. and they're lowering rates as the stock market collapses. So I think the Fed is kind of a little bit ahead of the gun here, a little bit ahead of the schedule, trying to front run things and soften things even more. But overall, I'm still net, longer term. I'm bearish on the markets. I do think we're going to see a bigger correction down the way, and this is just part of that journey to get there, because this is a very, very big bull market cycle. It takes a long time for all this stuff, not only the technicals and the stock market to stall out, but for economics and policy, all this stuff to change for things to really kind of take hold. So my outlook from last time you and I talked is I'm still bearish looking forward like a year from now. I think the markets could be sharply lower, but the equities market is still trending higher. And I think bonds can move higher here as well.
Are you liking the video so far? Well, before we continue, let me tell you about an innovative way to create videos, which I can tell you from personal experience can be challenging and time consuming. Today's sponsor, InVideo AI, makes the process incredibly simple. Whether you are a content creator, marketer, or business owner, InVideo AI transforms your ideas into polished, professional quality videos in just minutes. It's the world's most used AI video creator with over 10 million users across 150 plus countries. All you need to do is type out a text prompt. From there, you can get creative and fine-tuned ideas for your videos using just text commands. It's like having your own video editor on standby. And the best part, you can clone your voice and make it narrate the videos in your own voice in any language. It does the job of more than 10 tools packed into one and costs just $20 a month to start with. Scan the QR code on the screen here or use my code linked down below to get 2 times the video generation credits in your first month. Well, here's the thing now, Chris. If you don't mind, I'm going to flip over to my screen for just a bit here. So this is the CME Fed Watch tool. The market, mostly the bond market here, is projecting a high chance of the Fed funds rate falling to 275 to 325 by July next year. That's a 200 basis point decrease from current levels. Now, the Fed's own median projection, and of course, we can debate whether or not this is going to be accurate, but the Fed's own median projection by next year is going to be 3.25, which means the market is more aggressive in pricing in lower inflation than the Fed themselves. This leaves a lot of room for error. Suppose the Fed does not do this, there could be a lot of room for disappointment in the stock markets. What's your take on this?
Yeah, it's tough to gauge. I mean, if the Fed lowers rates and they lower it too quick, it's going to kind of spark somewhat of inflation from a different angle. I still think we need more time. I think this whole cycle really takes several quarters to unfold, and I think we're slowly working our way there. I do think probably by the end of this year, I think inflation will probably hopefully be capped and want to just keep kind of going lower, because I think the economy is slowing. I was looking at a lot of unemployment data or where job layoffs are. It's really big in manufacturing and business services, leisure, hospitality and leisure, retail. Really, those are all the things where growth is. If factories, like I used to be in manufacturing business, I have my own health product business. And so I've been overseas and I managed all the manufacturing. They are like a major leading indicator. If factories are already laying off tons of jobs, then the orders from factory or from companies are slowing. And that's usually like 3 or 4 months lead time. So, the manufacturing number actually to me for unemployment is better than the transportation index, because now transportation index, which usually is a good gauge, is completely blurred because everything is shipped online. Amazon is completely everything is shipped. So there's more shipping going on, but it's masked by like small consumer stuff, not like container loads of product. So anyways, my thinking is things are slowing. There's a lot less leisure, a lot less traveling. People don't want to spend $400 or $500 for a dinner that they're not really that happy with. It's just so expensive to do stuff. People are tightening their wallets. And it's already showing up in the manufacturing numbers. Manufacturers are cutting staff because they just don't have the orders. So that's where I see this happening. So I still think we're 3 or 4 months out from things really turning a corner and people going, okay, things are really getting slow. And retail space had good earnings, good numbers not that long ago. And we saw the retail sector take off. But if you look, retail is one of the biggest areas they've been cutting jobs. So have they really been making more sales, or have they just slashed a lot of labor costs and lowered their operating exposure, operating expenses? So there's a lot of stuff to weave through. But from a high level, that's kind of what I see.
Well, just to your point, the advanced retail sales have been going up to record highs in nominal terms. However, if you take a look at it from an annual percent change basis, the pace of growth has not been growing up. In fact, it's been just kind of flat. So it's just steady, slow growth for retail. Do you think that the consumer is going to have a little bit more leeway once credit card rates eventually fall down? I'm not saying it's going to fall down immediately. It doesn't track the Fed funds rate 100%, but at some point, maybe if it goes down, maybe if mortgage rates go down, we'll talk about housing in a bit. Maybe if the lines of credit rates go down, perhaps consumers will load up more on spending. Can you see that happening?
Possibly. I mean, we are seeing a big skyrocket in credit card delinquencies right now. And we kind of have like one of the highest levels where usually there's like a rise in delinquencies, but their cards aren't maxed out. Right now, the majority of people have their cards 90 to 100% maxed out and they're not paying. So, I mean, this goes with, unemployment starting to rise a little. People have burnt through their savings. We've talked about this in our previous chat or two, how excess savings in the States has fallen and people have burnt through that. And now it's bleeding through to the credit cards and there's delinquencies. I think a rate cut will maybe help some people try and pay it back sooner, but I don't see how a 0.5% is going to save the world or save the economy myself. If a business is like hanging on to like a thread, a 0.5 percentage point isn't going to bring it back and spark a booming economy. So the whole interest rate stuff, it has such a small nominal change, in my opinion, for the masses. Sure, it might miss out on 10 or 5 million or 50 million in interest for some super wealthy people. But for the masses, 0.5% doesn't do anything. If they can't pay their debt, 0.5%'s not, they still can't pay it, right?
Fair enough. What about for the factories? You talked about manufacturing earlier. What about them? Are they going to start, reinvesting back into capex spending and investment now that the rates are falling again?
Well, if you look at industrial like capital goods, especially the sector for it, actually I can pull the chart up real
Yeah,
quick and kind of
please.
show you a visual. That space has been doing very well. Let me just XLI. Here, it's just been ripping to the upside at all-time highs, and we've already seen what you just said, David. Is companies have had stellar few years, and they've all been upgrading their facilities, buying new assembly equipment, whatever they need for their warehousing and all that stuff. And so these industrial companies have just got like super super strong growth, and everybody's been piling in, and so there's big earnings, and I think everybody has more or less already upgraded, and now things are actually starting to stall out, and people are going, holy crap, how much do we just spend on that new assembly line for all this new demand we have, and now demand's dried up. And now a lot of these people did financing when the rates were high, like, over the last 6 months.
Yeah.
So they have like high debt now. They have these big expensive machines. And now I think we're going to start to see, spending from the consumers drop off, which means less demand for the equipment. And these people are going to be scratching their heads going, what did we do? We should have just stuck with our old assembly line. It was paid off. So I think we've already seen that wave, which is why industrials have just taken off and they've got great earnings. I think we're just in this late stage where we're just waiting for the music to stop. Things are slowly coming around and stalling out across the board for stocks and the economy and the consumer. And it's just a matter of waiting for that music to kind of stop. And then we're going to see a shift in momentum. And people are going to start to really tighten up on their wallets. Once we have a bit of a turning point here, we haven't had it yet, but there's going to be a wave where the masses, it's like a school of birds or flock of birds or school of fish, they all see the same thing at the same time. They're like, holy crap, we're in a recession or things have tightened up, and it'll spread like wildfire. And then we're going to see a very quick shift, but we're not quite there yet.
I want to do something a little bit different today, Chris. I'm going to flip over back to my screen. And what I did was I asked ChatGPT, and we're going to evaluate if it's right. Which stock sectors have historically outperformed during a Fed easing cycle? So here are all the sectors it's given and the rationale. So we've talked about consumer discretionary just now. We talked about industrials. Let's evaluate the other sectors. Technology. Lower interest rates reduce the cost of capital, making it easier for tech companies to invest for innovation. I'll let you flip back to your chart in just a minute and take a look at the technicals for these sectors. Tech, financials, while the initial impact of lower rates can compress net interest margins, that's key because usually in a rising interest rate environment, financials have higher net margins. But here it's saying easing cycles often stimulate lending activity. Real estate, lower interest rates make borrowing cheaper. Okay, that's a given. Industrials, we talked about. Utilities are considered defensive stocks with stable cash flows. During an easy cycle, their high dividend yields become more attractive as bond yields decrease. So it's seen as a basically competitor to yields, which become lower. Okay.
Mhm.
Just on the surface, do these rationale make sense to you? And then we'll take a look at the charts.
Yeah, so I think technology. I think lower interest rates going to help technology. I think the sweet spots here right now. We've been seeing a lot of flow into real estate. People are nervous. When they get nervous, they exit the stock market. They go to real estate. Falling rates, as you just said or showed here, is generally bullish for real estate. Makes it easier for people to get it. So we've seen like IYR, the real estate, the REIT ETFs moving higher as just a default. When people don't know what stock to pick, they naturally go to like something they know or own, which is real estate. So we have seen that. Utilities, the utility sector you showed at the very end there have been on an absolute tear to the upside. We haven't seen outperformance like this since just before COVID. And last time we had like gold and utilities outperform like dramatically, it led to a 2008 crisis. It was like whatever you want to call it, a black swan or just the global financial crisis. It also happened just before the COVID crash. The charts and everything are lining up. And I know I keep saying this, every time we interview, but I'm not saying it's going to happen right now. I'm just saying it is getting closer and closer. And all these things that you're bringing up here, David, are just kind of solidifying, what is unfolding. I had a member send me an image, and they did some research, and this guy posted on Twitter. They were saying just 86 stocks accounted for half of the total stock market wealth created over the past 90 years. Less than half of the stocks in the universe generated any returns for investors, and less than 4% of the thousands of stocks in the universe accounted for virtually all of the market gains. So 86 stocks for most of the gains for the last 90 years is crazy. It just goes to show stock picking is super difficult, and why the indexes and playing overall a rising tide stock market, you want to hold it. A falling stock market, you don't. I don't like the whole stock picking game myself. I'd rather just, if the tide's going up, let's ride the tide up, or get a little more advanced and ride the waves during a rising tide, and also ride the waves during a falling tide, changing your strategy to benefit from rising and falling waves. So it's, the markets are very, very interesting and unfolding here. And a lot of people who pick individual stocks have I know people have portfolios of like 150 plus individual stocks, and they struggle, super volatile. And the reality is most stocks just don't actually perform or generate a return for people. You really have to ride the tide, the indexes, which is why I love ETFs. At least if you're going to pick a sector, you can take the whole sector, not just a couple stocks from it. So it really comes down to your personality, what you like. I don't want something extra challenging. I'd rather just identify waves and cycles and take advantage of the money flows in and out of those. But as you said, the rates and all this stuff coming together are affecting all of these sectors. And I think we're in this final stage that I think this year will be a major market top. We just need to let the momentum fully stall out, and for the sentiment of the herd mentality to change gears.
This year, 2024 or 2025?
I think 2024 we'll see the stock market top out here. I think a lot of it's going to be dragged out till elections, all that stuff. So
I see. Well, okay. So what I have here is the S&P 500 versus the tech sector, the NASDAQ. So the NASDAQ has still outperformed. I just want to see what happens when you overlay it with another sector. Let's take a look at utilities. So if we go here.
You can do XLU if you want, or
XLU.
utility.
Yeah, that's probably a good bet. All right. XLU has started to outperform the S&P 500 as of basically a month ago, like you pointed out. Let's take a look at something really interesting here. This is the consumer. This is the financial ETF. Not quite, but let's do consumer staples.
XLP.
XLP. Yeah. Underperforming, so people aren't moving into defenses as much. And then help me out here, consumer discretionary.
XL.
C, I think.
Yeah, I think it is.
That's communication services.
No. I'm trying to think what it XLY.
XLY. That's hasn't picked up yet. Oh, actually, it has. If you just take a look
It
at the
depends. It
year to
depends where
year,
you put the start
year
date,
to date,
right? If
yeah.
you
In the last three months,
if
it's
you're to do that even
outperforming.
with consumer staples, in a shorter time frame, it's not about how much it's outperformed over the past year. It's more like
Yeah,
over the last month or
yeah.
2 months.
In the last 3 months, consumer discretionary started outperforming, and then consumer staples is yeah, started outperforming as well. So yeah, what's going on here? People just rotating into specific sectors.
Yeah, I mean, generally when people get nervous, they want to make sure they have a company that, you're going to always need toilet paper, toothpaste for consumer staples. Utilities, no matter what, we need electricity, running water. Utilities are huge with debt. They have massive amounts of debt. So falling interest rates is very good. It'll lower their servicing, their debt servicing. So that's good for utilities. But again, people naturally go to utilities as a defensive play, high dividend kind of payout. So that, I mean, money is just flowing into the defensive plays, consumer staples, utilities, gold, and we're just seeing money move into those areas. That's just generally not a good sign. We're going to probably see some type of bigger, sharper correction.
I'll let you flip over to your screen. What are the major levels of the S&P 500 that you're looking out for now, from now to the end of the year?
So yeah, if I was looking at the SP 500, let's just zoom in on a shorter term chart. So this Fed move that we've had has potential. If we were to just use a Fibonacci extension based on some of this analysis, there is potential here for the SP 500 to rally roughly from where you and I are today. Grab that tool back here. We could see like about a 4% move to the upside, which is the 6,000 mark, which is a whole number for the SP 500. Whole numbers are like a 6,000, 6,500, or 5,000. They're whole solid numbers. And the reason they act as a resistance zone is people will say, well, if it runs all the way up to 6,000, I'm going to sell. Like, that'll be awesome. So there's naturally, if you're under a whole number, when you bump up and hit it, there's going to be a lot of orders saying I'm getting out at 6,000. So it'll act as a resistance area. Not only that, but the daily chart here is saying this high momentum play coming out of the Fed and out of this pit low that we saw in early September, the momentum is taking us all the way to 6,000 as well. So there's about 3.75% probably percent upside in the SP 500, and the Nasdaq probably has a little bit more than that, simply because it naturally moves more percentage wise. But if the SP 500 goes up, we'll probably see the Nasdaq with it, or vice versa, whichever one will drag the other. Like, the SP 500 is outperforming; it's making new all-time highs. The Nasdaq is not,
Yeah.
and that's simply because the large mega caps, people kind of took a back seat, and they got a little nervous with that big correction we had about a month and a half ago, and that really shook people up to see positions fall 17% or so, spook them. So we're not at all-time highs. People are a little slow to get in, but we are starting to see money pick up. Tesla has had a couple nice days. Nvidia is starting to get some real traction today. So there's definitely if we take a look at Nvidia, we're really seeing some big volume moving into Nvidia. It's starting to break out today, and maybe it's coming back to life. Nvidia actually has a pretty nice chart pattern here in terms of where it should go, just based on the simple Fibonacci momentum. It should go back up to 133, and that is a 10% move from where we are, and that will drag the entire market up with it. So there's pretty good underlying technicals that if the big techs get traction here and people start to pile back in, which Nvidia is leading the way, which is a good sign. I got a feeling we're going to see this market have one more push higher.
So you're still long for now. What would be the inflection point? At what point do you think to yourself, momentum is waning, it's time to take the other side?
Yeah, I mean, we're going to need to see price flatline, chop around for a little bit, or
Okay.
start to pull back for a few days. This upward momentum is kind of how we look at things. So we have this upward momentum. Eventually, this is a 30-minute chart on the left. Eventually, it'll need to come down and start to break some lows. And if it trades sideways or slightly downward for long enough, that upward momentum will stall out. And of course, it'll also count, where is money flowing? Is money flowing into defensive sectors like we just talked about? If price goes sideways or pulls down a little bit in the stock indexes, and there's huge money flowing into the defensive sectors, gold, utilities, consumer staples, all that stuff, that is not a good sign. And our strategy will probably say, hey, get out because the SP 500 is now stalled from a short term momentum basis. It's lost its upward speed, and money is actually flowing into the boring defensive sectors. They're not looking for growth. And so our strategy will probably kick us out. So it takes both a combination of time at price action and actually like money flows of price can pull back and still be very strong. But if price pulls back and the underlying technicals break down, because money is really nervous and becoming more and more nervous, not going into small cap stocks, not going into micro caps, which they're not really right now. Today's an update in the equities market, but micro caps are getting hit pretty hard. Overall, that's never a good sign. So we don't need much for this market to roll over. It just has to flatline for a little bit and have the underlying technicals kind of erode. And we're at this really critical tipping point where the stock market is kind of flipping and flopping, trying to figure out what it wants to do. And the last time we had this type of scenario, actually, I can come over here. We talked about this last time. The scenario that we're in right now is very similar to this 2022 market top. So we're kind of in a very similar scenario in terms of price action, in terms of all the underlying technicals, the momentum. And then we went into a bearish environment for a year. 2022 was a very difficult year for most people. And now we're back into this bullish environment. We have these trend change signals in the markets. And we just need to be aware we're in this choppy phase. This market might push a little bit higher, like I said, 3-4%, but then it could start to break down and go into something much bigger. So that's kind of where I think we are in the grand picture. This is the weekly chart of the SP 500. So, looking forward 2, 3, 4, 5 more weeks, this market could still work its way higher or sideways. It doesn't mean, we're going to top just yet. And there's still potential for a squeeze up.
Okay, so people can learn more about Chris's investing strategy in the link down below. We can learn about his asset investing. We've talked a lot about that in the past. We can also revisit our last interview where we discussed this. So I just want to get a sense of your strategy here and use this as a real life example of asset investing at play. So first of all, why wouldn't you? I guess potentially you would, but what is your take on taking the contrarian play right now? As momentum to the upside is still strong, why would you not look at the chart and say, look, I'm going to be contrarian. There's euphoria on the upside for now. Why not go into a less crowded trade?
Against the markets so that when it falls, you make money.
I guess that's one way to look at it. Sure.
To me, so the long-term trend here, this is the weekly chart, from the rising tide, falling tide environment, we're still in a rising tide. So we are still in, for individual stocks, not really, but for indexes, we are in a bull market. From a short-term standpoint, we're still long. I mean, not one to, I don't like tops or bottoms. I like to mentally oh, this looks and feels like a top or bottom, but I don't actually take action on it. I don't against the market. I know a ton of people have been adding triple leveraged inverse ETFs, and they're expecting the markets to fall, and it keeps pushing up, and they're feeling maximum pain. I just don't do that, and because the reality is, David, when we're in this type of market that's rising, and the markets are constantly nervous, it is going to top. And there's nothing wrong with that, but you have to have a strategy so you still trade with the trend and you don't try betting against the market. So the contrarian play is picking tops and bottoms, or is trying to pick a top right now. And I don't believe that's the play. Well, you might be good if you look forward 6-12 months from now, you'd be like, I nailed it. Within a couple of these weekly bars, there could be a ton of pain in that process, because sometimes some of the biggest moves happen right at the end. We have some huge spike up in price. It's absolutely insane, sucks the whole world back into the stock market, and then it rolls over and dies. We see that happen all the time at market tops and bottoms. So the contrarian play is, you're betting for the underdog. The odds are against you. It's fun. Yeah, it can be profitable, but it's just not worth it.
We have to talk about gold now, Chris. Before we go, gold has just been continuously, every time we talk over the last couple of months, it just seems like gold's been hitting new all-time highs, right? So right now, today on Tuesday, the 24th of September, on my screen it's at 26.74. I'll let you comment on this. Is it just full blown overbought at this point? or what's going on? Or is it just the beginning of a much larger up move?
Yeah, good question. I don't think it's overbought. I don't think there's euphoria and like everybody's piling into it. It's drifting higher. It's not like it's got crazy volume. Gold, you and I have been talking for quarters, really. I
Hmm.
mean, when we look at the weekly chart or the monthly chart of gold, it doesn't matter how far back we go. We can take this Fibonacci measured move. We can go all the way back to the beginning of the early 2000s during this rally and pull back and do a Fibonacci measured move. All the time frames actually point to 2650 to 2750. We're now at like more or less 2677. So we're in that window that goes all the way back like 20 years, 24 years almost. Where multiple price charts are saying, hey, when you hit 2650 to 2750, gold's probably going to be about done its move, and we're going to see some huge shift. We're going to probably see the stock market change, reverse, probably gold, the economy. There's going to be a whole new pivot, be a whole new world once the market has this new financial reset, whatever they're going to call it after it's done. So gold, yes, gold I say doesn't have a whole lot of upside left. I think that move is done. I think you can still be in it. I think it might still want to drift higher. The chart still looks really good on a daily chart, but overall, this is not a place to be buying gold. I do feel like we're going to see gold pull back probably 25 to 35%. Somewhere back down into the middle of this range, which really comes into this high. It's very similar to what we saw in the 2008 financial crisis. Gold pulled back 34%. Silver pulled back like 67%, something like that. So yeah, you could say it is overbought. I wouldn't buy it here. I think there's going to be a great opportunity for precious metals once this music of the whole economy and the stock markets, all this stuff stalls. And this is what I've been preaching for a while. I'm super excited. I can't wait for the precious metal space. I can't wait for a financial reset because then real estate, all these things are going to become amazing opportunities. And right now it's like, we're in this peak risk. I have like just a simple chart here that just shows as an investor, if we were to just zoom in on this one particular chart, we are in this phase right here of peak maximum financial risk. I don't care what you put your money into right now. I don't think there's a whole lot of upside left in anything like stocks, bonds, even like government bond. Like if you put them in like a GIC, like in Canada and try and make your rates are going down. Like there isn't a safe place really anywhere unless you take advantage of a falling market, which through inverse ETFs or playing a different asset class that might go up, like the US dollar, if everything collapses. So we're in this point where it's like we all have capital, we want to invest, we want to make more money, but we're actually have to kind of sit on our hands and just know we're in a very difficult market condition that's really difficult to trade. We're in this stage 3 top. It's choppy. It's been like this since 2021 for small cap stocks, most sectors. And we just have to know like this is like just preserve capital, put up with, average kind of poor returns and wait for a stage 4 decline or a new major bull market to start. I don't care which one happens, preferably a stage 4 because things need a reset. It's good for a lot of people. So that's kind of where I see things at this point.
Okay, well, don't you think that, well, you brought up real estate. Don't you think real estate is the asset to hold during an easing cycle? Or am I wrong here? How does it usually perform?
Well, real estate will pull back as well. I find there's a big delay. Like stock market will kind of crash first. The economy gets really weak. Housing kind of follows.
Mm.
People default on mortgages and burn through all their savings. It can take months or a year or two later. So real estate will be really weak. Real estate will weaken with the whole market. I believe real estate will bottom like a year or two after probably the stock market has bottomed until everything's really wash through the system and banks. Like, I mean, a lot of people are talking about banks. Everybody wants to get into banks. I was at the Toronto Money Show, which by the way, a ton of people said they saw our interview because we talked about, I was at the Money Show at the previous weekend.
Nice.
And tons of people showed up from the David Lynn report, which was awesome. Lots of photos. Anyway, real estate will be a big delay. And a lot of people are like moving into banks. And I'm like, why do you want to hold banks? Like, to me, it doesn't make sense. Banks hold all the debt, a lot of credit cards, mortgages. Defaults are like rising and delinquencies across the board. Like banks are going to be left holding the basket and it'll be another banking and financial crisis. You generally don't want to hold stuff in the financial space if there's a financial crisis. But I mean, the general public usually does the complete opposite of what I'm thinking or seeing, just because I use logic and they're using emotions and just more or less lack of understanding how the markets fully work and stuff like that.
You say there's nothing on the upside. Is there anything today that you can share? And perhaps if you haven't looked into this, we can talk about it next time. But is there anything today that you can share that is not yet fully priced in, not yet fully fairly valued? In other words, undervalued.
That's a tough one. I'm not really sure. And
Okay,
that's
let me pitch
which
something
is
to
why
you.
I brought out that point. We're sitting on our hands. We're like, I don't find that there's any like really great opportunity.
I,
That's
I,
just
I keep hearing from people that the mining sector is undervalued. Now, granted, a lot of these people are working in the mining sector, but anyway, that's what I'm hearing. Okay.
yeah.
And the rationale is because the GDX or GDXJ, whichever of the indices you take, have not been trading higher than their previous all-time high in 2011. Yet take a look at gold, new all-time highs every single week that we talk, Chris.
Yeah.
So clearly there's a disparity between the underlying metal and the stocks. That's the rationale, or one of the rationales for why gold stocks are a great buy right now. Do you buy into this theory?
Uh, Not really. I mean, if we look at GDX and we look at the chart, gold would be equivalent to trading like way up here, all-time
Yeah, that's
highs,
right.
and miners are struggling. They're way off. But the thing is, I mean, gold miners. I don't follow their fundamentals too much, but I know everything is crazy expensive, and I know
Sure.
it costs a hell of a lot more to get gold out of the ground and process it and everything now. That even with gold being up at all time highs, I still think the profits are still really down. I think gold has to have that huge pop and break to really extend, and this space just doesn't quite have the love. I mean, I think. I don't think it's a mass move play yet. And right now it's a lot of people in the space moving in, driving the markets up, but it's not like we have like crazy massive volume. It's not headline news everywhere. So this is just, people I think actually a little too early to the game. I think we're still going to have a financial reset. I think miners are going to be like GDX could probably be very easily back at 25 or 20 if we have another financial reset. Maybe even 15. I mean, it dipped down to 15 in 2008. It could very easily do that. So from a fundamental standpoint, I still think fundamentally they're not really that good. Now there might be the occasional gold miner that's like crushing it and should have crazy pricing, and it's not. And that's because it's grouped into the mindset of gold miners, and they're just not moving. It's just not a fully live sector yet where it's breaking free new all-time highs.
Let's close it off here. Great talk today, Chris. Great update for us. So we can follow Chris in the link down below. Where else can we learn from your work?
Yeah, you can go to our website, thetechnicaltraders.com, or go to my YouTube channel, The Technical Traders, and I break down the charts, much shorter term time frame, kind of every few days, and get an update on the pulse of the market.
Follow the links down below to learn more about Chris's work. We'll see you next time, Chris.
Thanks, David. Take care.
Thank you for watching. Don't forget to like and subscribe.